Everyone. Welcome back to another episode of Flexify 2. I'm your host, Trina. And today we're going to chat about a topic that gives a lot of independent contractors, freelancers, and gig workers absolute highs: retirement planning. Look, I get it. When you're running your own show, whether you're a 1099 IT consultant, a freelance graphic designer, door dashing, stylist, or driving rideshare full-time, your day-to-day focus is on cash flow. It's about landing the next client, chasing down unpaid invoices, and managing your current projects. Thinking about what your life looks like 20, 30, or 40 years from now likely takes a backseat. According to recent data, a staggering number of self-employed folks have exactly $0 saved for retirement. And it's not because they don't want to save, it's because the traditional system isn't built for them. When you leave corporate life, you don't just leave behind bad coffee and painful Zoom meetings. You leave behind the HR department that automatically sets up your retirement plan and hands you a company match. Suddenly, you're on your own. But here's the good news. The tax code actually hides an incredible superpower specifically for people running their own show. It's called the solo 401k, sometimes called an individual 401k. And today, we're going to take a deep dive into it. We'll cover exactly how it works, why it might be the ultimate retirement cheat code for independent contractors, and because I give it to you straight, the distinct drawbacks you need to watch out for. Kick back, stretch your legs, and keep your ears peeled. All right, let's start with the basics. What is a solo 401k? At its core, a solo 401k is not a fundamentally different investment vehicle than the 401k you get working at a company or a bank. It follows the exact same IRS rules. The magic lies entirely in your corporate structure, or lack thereof. When you are an independent contractor, you wear two hats. You are the employee, the person doing the grinding, watching the budget, or delivering the service. But you are also the employer, the visionary, the business owner, the person running the enterprise. Because you wear both hats, the IRS allows you to contribute to a solo 401k in both capacities. This is what differentiates it completely from the standard IRA or even a SEP IRA. Let's dissect how those two hats work when it comes to funding the account. First, you have your employee hat. In 2026, you can contribute up to 100% of your earned income up to a maximum of $24,500 as an employee. If you're 50 or older, you get a catch-up contribution option, allowing you to add an extra $8,000 to that. Then you put on your employer hat. Your business can turn around and make a profit-sharing contribution of up to 25% of your net self-employment earnings. When you combine both those hats, the total maximum you can shield from taxes and save for retirement in 2026 is $72,000. To put that into perspective, a traditional or Roth IRA caps you out at thousands of dollars less per year. The solo 401k lets you supercharge your savings at a speed that traditional accounts just can't match. But who qualifies? The rules are strict but simple. You must have self-employment income, meaning you receive 1099s or run an LLC, S Corp, or sole proprietorship. And you must have 0 full-time employees. Now this is clutch. There is an exception to the employee rule: your spouse. If your spouse works in your business with you, they can be added to the plan, meaning you can essentially double your household's tax shelter savings power. But if you hire regular non-spouse W-2 employees who work significant hours, you immediately disqualify yourself from the solo version of the plan. Now that we know what it is, let's talk about the why. Why should you care about this over other options? I've boiled the core benefits down into 3 major points. The first benefit is the sheer mathematical leverage it gives you. Let's compare it to its main rival, the SEP IRA. A SEP IRA only allows you to contribute as the employer, meaning you are strictly limited to about 20 to 25% of your net income. Let's do some quick math. Say you make $100,000 in clean net profits this year from your freelance business. With the SEP IRA, 25% means the absolute most you can save is roughly $20,000 to $25,000. But with the solo 401k, you can put away $24,500 as the employee first, and then add 25% of your remaining net profit on top of that as the employer. On that exact same $100,000 income, you can save close to $45,000 to $50,000. You don't need to be making millions of dollars to stash away serious cash. It is the fastest way for middle-income gig workers to build a nice nest egg. Benefit number 2 is the tax flexibility. Unlike traditional standard business retirement accounts, many modern solo 401k providers allow you to choose between traditional and Roth contributions. If you choose traditional, you get an immediate tax deduction today, which lowers your current tax bill. That's amazing if you're in a high tax bracket right now. But if you're just starting out, or if you expect your income to grow significantly in the future, you can choose the Roth option. You pay taxes on the money now, but it grows entirely tax-free. And when you pull it out on retirement, you don't owe Uncle Sam a penny. Even better, under recent tax updates, employers are increasingly allowed to make their matching or profit-sharing contributions into Roth accounts as well, giving you unprecedented control over your future tax situation. The third major benefit is something a lot of people don't know about: the ability to take out a loan against your own account. Look, gig work and contracting can be highly volatile. You might have a golden year followed by a dry spell. With an IRA, if you put money in and suddenly need it to cover an emergency, taking it out early triggers a devastating 10% IRS penalty plus regular income taxes. It feels like your money is trapped behind a wall of glass. But a solo 401k plan can be written to allow participant loans. You can borrow up to 50% of your account balance, up to a maximum of $50,000 entirely penalty-free. And the best part? When you pay the loan back with interest, you are paying that interest back to yourself, not to a bank. It provides a possible financial safety net that gives solo business owners peace of mind. So it sounds like the perfect retirement account, right? Higher limits, great tax breaks, spouse inclusion, and you can borrow from it. Sounds like a dream. But as your trusted business peer, I have to give you the catch. There's no such thing as a free lunch in the financial world, and the solo 401k comes with some real administrative baggage and strict boundary lines. Let's talk about the drawbacks. The number one drawback is paperwork. When you open an IRA, you click a few buttons on an app, deposit money, and forget about it. It's practically zero maintenance. A solo 401k is a different beast. Once your total account value hits $250,000, you are legally required to file an annual informational return with the IRS called Form 5500EZ. Now, filling out the form isn't impossibly difficult, but forgetting to do it is not the move. The IRS does not play around with this. The penalty for missing the Form 5500EZ deadline is $250 a day, up to a maximum that can completely gut your savings. You have to track your balances closely every single year and ensure you remain compliant. The second drawback is that the solo 401k can actually limit or complicate your business growth. Remember the primary rule: solo means solo. Let's say your freelance business takes off, you're swamped with work, and you decide to hire a full-time virtual assistant or junior designer as a regular W-2 employee. The moment that employee hits the IRS eligibility thresholds, typically working more than 1,000 hours in a year, your solo 401k loses its solo status. You are then forced to convert the plan into a traditional full-scale corporate 401k. That means you have to perform the complex compliance testing, pay much higher administrative fees, and crucially, you may be legally required to offer matching contributions to your new employees. If your ultimate goal is to scale up from a solo contractor into a company with a team of employees, the solo 401k creates a significant operational hurdle down the road. Finally, there's the setup friction. You can't just wake up on April 14th, realize you owe a bunch of taxes for the previous year, and open a solo 401k to fix it. To make employee elective deferrals for a tax year, the plan itself generally must be legally established by December 31st of that year. You have until your tax filing deadline to actually put the cash into the account. but the legal framework must exist before the clock strikes midnight on New Year's Eve. Furthermore, getting an account open requires you to have an employer identification number from the IRS. It's not an overnight process, and it requires forward thinking and intent. So where does that leave you? If you're an independent contractor, freelancer, or gig worker who values maximum control, wants to slash their current tax bill, and plans to stay a lean, agile operation of one, or just you and your spouse, the solo 401k hands down can be one of the most powerful financial vehicles available. The ability to stack up to $72,000 a year into a retirement account is unmatched by almost anything else out there. However, if you hate paperwork, don't want to worry about IRS filing deadlines, or plan to hire a team of employees in the near future, you might be better off sticking with a simpler option like the SEP IRA or traditional Roth IRA, accepting the lower contribution limits in exchange for simplicity. The most important takeaway I want you to have today is this: doing nothing or researching nothing are two very real mistakes. Being your own boss is incredibly rewarding, but it means you are completely responsible for your own future. No one is going to hand you a pension or auto-enroll you into a fund. You have to build the safety net yourself. If you want to look into setting up one, look at major online brokerages. Many of them offer basic solo 401k plans with low or zero setup fees. Just make sure you talk to a CPA or a qualified tax professional to look at your specific income numbers before you make your final contributions. That is all for today's episode. If you found this helpful, do me a huge favor. Leave a review and share this episode with an independent contractor or freelancer who needs to start thinking about their future. Until the next episode, keep grinding, keep building, and take care of your future self. Be blessed.